Hello and welcome to another edition of Markets in 2 Minutes. This is Darrell from the WealthSpire investment team. For this edition, we're going to focus on the double-edged sword of the strength in the US dollar. So the US dollar has strengthened considerably this year, and the index that measures it against a broad basket of currencies is up 17%, currently at its highest level in over 20 years. There are a number of reasons that we've seen so much strengthening in the dollar, but all of them really tie back to the notion of how quickly the US economy heated up as we emerged out of the pandemic, especially relative to other economies around the world. And at first glance, that's generally a good thing, especially for those of us looking to travel abroad. But as I hinted at a moment ago, that strength, and especially the speed with which it's taken place, comes with some downside as well. The first consideration is that currency extremes can threaten corporate earnings growth, especially for companies with a significant presence overseas. And we've started to see some of that come to light in recent third quarter earnings calls, with many companies citing the strength of the dollar as a headwind for earnings moving forward. And on top of this, dollar strength also has a significant impact on international equity returns for US-based investors. And that's simply a result of the fact that when you invest in a foreign stock, you need to do so in the local currency and then convert back to dollars when you eventually sell the position. So if the foreign currency declined during the investment period, then a US-based investor would book a loss on that part of the trade. And in fact, on a year-to-date basis, currency moves have accounted for over half of the negative returns that we've seen in foreign equities. And speaking of foreign equities, it's clear that some of those concerns that we've discussed at the top of this discussion are being reflected in valuations, with US equities starting to look considerably more expensive on a price-to-cash flow basis. And one other interesting takeaway from this chart is that the last time that relative valuations pushed higher for a sustained period was from 2014 to 2017, which just so happens to be the last time that we saw a sustained rise in the US dollar. And of course, valuations are merely just a reflection of the market's perception of relative risks. And so our advice to investors has been to continue to maintain global diversification, because when we look at relative valuations in their current state, it makes it much more tolerable for us to take on the added risks that come with investing in international equities at the moment, simply as a product of the fact that they're so much cheaper. So important to keep that trade-off in mind as we navigate these choppy markets and we find ourselves vulnerable to headline risks. And we'll continue watching all of this over the coming weeks and months, so stay tuned for more from our team. Thanks for watching.